As of today, Saturday, January 24th, 2026, the stock market is closed. Beyond Meat Inc., trading under the ticker symbol BYND, finished the last active session on Friday at a closing price of $0.92 per share, representing a decline of approximately 2.03% on the day. For those tracking the pulse of the market through the lens of individual brokerage accounts or the Fidelity trading platform, this sub-dollar valuation is a stark confirmation of a reality that has become increasingly difficult to ignore. While the expectation among a niche group of retail traders was that the early 2024 and 2025 cost-cutting measures would finally bridge the gap to profitability, the reality is a brutal contraction of both the top and bottom lines. The most jarring insight right now isn't just that the stock is a penny stock by every definition, but that the very financial lifeblood of the company has been fundamentally rewired in a way that most casual observers haven't fully grasped. In late 2025, a massive debt for equity swap essentially handed over the keys to the kingdom to creditors. While this technically cleaned up the balance sheet by converting over $1 billion in debt into shares, it triggered an astronomical dilution event. We aren't just talking about a few new shares hitting the market. The share count surged by over 400%. If you're checking your Robinhood investments or looking at your SoFi active investing dashboard and wondering why the price won't move even on good news, it's because the denominator of the valuation equation has exploded. Every dollar of future profit is now split among 5 times as many shares as it was just a few years ago. Despite the common ground of plant-based eating being a long-term global trend, Beyond Meat is currently caught in a vice between cooling consumer demand and a shifting political landscape that is actively championing a meat revival. The recent introduction of new dietary guidelines by the U.S. Health Secretary has created a cultural and economic headwind that few saw coming. While investors using the Interactive Brokers platform might look for a technical bounce, the fundamental narrative has shifted from growth to survival. The expectation was that meat alternatives would follow the path of renewable energy, becoming cheaper and more ubiquitous over time. Instead, the reality is that the cost of ingredients and the complexity of the supply chain have kept prices high, while consumer curiosity has hit a ceiling. This isn't just a Beyond Meat problem, it's a category-wide exhaustion. Looking at the intraday activity leading up to this weekend, the trading volume remained heavy but lacked any signs of institutional accumulation. When you see a stock like Apple stock or Nvidia stock, you often see buying the dip from major funds. With Beyond Meat, the institutional activity has been largely characterized by selling into strength. Every time there's a small meme-driven rally, like the one we saw in October 2025 that briefly pushed shares towards $7, big players use that liquidity to exit their positions. For someone managing a self-investing strategy, the lesson here is about the gravity of dilution. Even if the company manages to double its revenue tomorrow, the share price might barely budge because of the massive supply of new shares created to keep the company out of bankruptcy. The business model itself has undergone a desperate pivot. Beyond Meat recently launched Beyond Immerse, a protein drink line, marking an attempt to enter the beverage space via direct-to-consumer channels. The expectation was that this would diversify revenue and tap into the protein cult currently dominating the wellness space. However, the reality is that the rollout has been cautious and limited to online sales, which does little to offset the double-digit declines in their core U.S. retail and food service sectors. In the third quarter of 2025, net revenues fell over 13% to just $70.2 million. The company is effectively shrinking its way to what it hopes is a smaller, more manageable footprint, but it is doing so while burning through cash. With only about $117 million in cash and equivalents remaining as of the last report, the clock is ticking. For those using the Robinhood app or SoFi Invest to track high volatility plays, the short interest on Beyond Meat remains a point of intense focus. At roughly 28% of the free float, there is always the expectation of a short squeeze, but as we've seen, those squeezes are often short-lived and serve only to provide an exit for the very institutions that original investors hope to beat. The reality of the squeeze narrative in 2026 is that it requires a fundamental catalyst to hold the gains, a catalyst that Beyond Meat simply hasn't provided. Instead of a turnaround in taste or price parity with beef, we are seeing a strategic retreat from markets like China and a consolidation of production that hasn't yet resulted in positive EBITDA. Comment below, how many shares of Beyond Meat stock do you currently hold, or have you already moved your capital into more stable assets like a Fidelity ETF or a Schwab Intelligent Portfolio? It's a question that gets to the heart of the current investor dilemma. At what point do you stop viewing a low price as a discount and start viewing it as a warning? Historically, Beyond Meat was the poster child for the plant-based movement. When it went public in 2019 at $25 and shot up to over $200 within months, the expectation was that it would do to the cattle industry what Netflix did to Blockbuster. It had the partnerships, McDonald's, Yum Brands, PepsiCo. It had the celebrity backing. But the reality of the food business is unforgiving. Unlike software, food has high marginal costs, physical distribution hurdles, and most importantly, the hurdle of human preference. The meat-like experience turned out to be a novelty for many rather than a lifestyle shift. As the novelty wore off, the high price point became a barrier, especially in an inflationary environment where consumers are scrutinizing every dollar spent at the grocery store. The technical setup on the Interactive Brokers platform shows a stock that is coiling at all-time lows. Some traders see this as a bottoming pattern, but a deeper analysis suggests it's a lack of interest. When a stock spends this much time under the $1 mark, it faces the real risk of delisting from the NASDAQ, which would force it onto the over-the-counter markets, a death knell for institutional visibility. This is why the company has been so aggressive with its share authorizations, recently increasing its authorized share capital from 500 million to a staggering 3 billion shares. This gives them the ammunition to keep raising capital, but it acts as a permanent ceiling on how high the stock can go. Looking ahead to the rest of 2026, the primary catalyst to watch is the first quarter earnings report. Management has set an expectation for positive annual EBITDA by the second half of the year, driven by a 20% gross margin target. This is a bold claim for a company that just reported a 10% gross margin and an operating loss of over $112 million. The reality is that reaching that goal requires a near-perfect execution of their global operations review and a significant rebound in consumer sentiment that hasn't materialized yet. If they miss these targets, the conversation will shift rapidly from turnaround to restructuring. In your online investing life, whether you're using a Robinhood cash management account to earn interest while you wait, or you're deep into a self-investing plan, Beyond Meat represents the ultimate test of the buy the dip philosophy. The expectation is that because the stock was once worth $200, it must eventually return to at least a fraction of that value. The reality is that the company that was worth $200 no longer exists. It has been replaced by a much more diluted entity operating in a much more hostile market. The intelligent portfolio move is often to look for companies that are growing their cash flow, not just trying to stem the bleeding. For those who still believe in the mission, the bull case rests on the idea that the current political and cultural pendulum will eventually swing back towards sustainability. If global environmental pressures mount and the cost of traditional livestock rises due to resource scarcity, Beyond Meat's infrastructure could suddenly become an incredibly valuable asset. But that is a long-term play that requires the company to survive the next 12 to 18 months of intense liquidity pressure. This is where the tension between expectation and reality is at its most taut. Investors expect a hero's return, while the balance sheet shows a company fighting for air. Ultimately, Beyond Meat is a cautionary tale about the difference between a great product and a great stock. You can love the Beyond Burger and still recognize that the financial structure of the company is currently working against common stockholders. As we move through January 2026, the focus shouldn't just be on the $0.92 price tag, but on the 450 million shares now in circulation and billions more that could be issued at any moment. The investment help you need isn't just about when to buy, but about understanding what you're actually buying, a small piece of a very large pie. To summarize, we started with a live look at BYND's closing price of $0.92, a figure that reflects a company in deep distress despite its past glory. We explored the massive dilution that has changed the math for every shareholder and looked at how a shifting cultural tide has made the meat alternative mission harder than ever. The expectation was a quick recovery. The reality is a long, painful slog through a debt-heavy swap. Whether you're using Fidelity Wealth Management or a Robinhood trading account, the key is to separate the vision of the company from the reality of